everybody, and welcome to the REDNews Austin Market Update. We are very happy you're here. Thank you, REDNews, for putting this on. And our panel is about office, which is an interesting topic because it is not what it used to be, and we're not completely sure where it's going. I think that we're all trying to figure it out on a day-by-day basis. So, what I have learned about office is it used to, in Austin, Texas, be very landlord-driven. Landlords were in charge, they gave you what you got, and you were very happy about it. And that has shifted in Austin, if not the entire United States, to where now tenants kind of are in the driver's seat because they get to say, hey, we've got a lot of options, and if you want us to go in your building, it's going to be this. So I bring all of that up because we had a panel call last week that could have gone for 2 or 3 hours discussing these topics. Very excited to have on the panel today decades and decades of experience in leasing office here in Austin and sales. So I'm going to let them introduce themselves, starting with Logan.
Hey, I think this is on. Hey guys, quick introduction. My name is Logan. I'm an office tenant rep broker with Cresa, and I focus mostly on tech companies and local business.
Hi everybody, I'm Condon. I'm with Avison Young. We're a full-service commercial real estate brokerage firm. My background is in office tenant rep, and occasionally I'll venture into industrial depending on my clients' needs, but most of my practice is centered around professional service firms, so think of law firms, accounting, engineering, those type of groups. I've been in Austin 27 years and been practicing 24, so I hope to bring a little bit of, that'll be kind of the context that I'll be bringing to the conversation.
I'm Hanish with PRAVO Construction. We're doing a good job of making sure we're not talking over each other today. We need to hand the mic down the line. We specialize in corporate interior, and so obviously it's been a pretty wild market here over the last 10 years that we've been in the market, and so I'm sitting up here with a lot of people from the commercial real estate side of it, on the brokerage side of it, so hopefully I'll be able to shine.
Yeah, I'm Alex Taghi with Franklin Street. I run our occupier services team here. 16 years in the business, started in Houston, moved to Austin in 2021. Excited to share some of my thoughts.
And it's back to me, and I forgot to introduce myself. So I know quite a few of you in this room. My name is DeLea Becker. I am owner and founder of Beck-Reit Commercial Real Estate and Beck-Reit Asset Management, and own an affiliate construction company that repairs the roads and bridges you drive across. And the hat that I wear today is office landlord, office owner, and I'm a partner in a development, but I am not the developer, but I'll be leasing space in that building. So I'm eager to hear what all the panelists are going to teach me of what to do and what not to do to fill my space. We will start with a very broad subject, but I know that each of you will get into the nitty-gritty. Current vacancy rates and leasing trends that are shaping the market. And my question to you is surprising trends that maybe not everybody in the room knows about.
I guess I'll start. I think the most prevalent leasing trend right now is just cutting spaces into more palatable bite-sized bids. So I think your market right now, and I'm speaking from an office perspective, downtown, dead central, is really scarce in 10,000 square feet plus deals, which is, I can't say new, but different than it used to be. So taking your 10,000s and cutting them into 5,000 square foot spec suites or more palatable floor plans is, I think, the most successful leasing strategy. That's the biggest trend or advice I could give to a landlord to move space.
Yeah, I don't know if there's any one thing. I mean, I think if anything over the last 4 years, we've just seen this, there's not been a broad rush happening in the market. It's like there's absorption is up one quarter down the next. It just feels like a bit of a yo out there. I think just on a macro level, there's still a huge importance on talent and the war for talent. And I think what you're seeing is the folks that are in the market are willing to pay on market terms a premium to be in the nicer buildings, the higher, better amenitized buildings, the better located buildings. And to the point of kind of spec suites, you know, the smaller tenants, which is a big part of the market today, that sub 10,000 square foot tenant, they are not interested in going through a full design, permit, and build process, and they're pushing that hassle factor, if you will, onto the landlords, and that is a must for getting deals done. I think you either have to be willing to invest in your building, whether it's amenities or in the space, to attract the type of talent that these companies need to attract, or you have to be able to just kind of push the easy button and make those tenants just say yes.
Yeah, and when we're talking about vacancy rates and net absorption and stuff like that, I think these guys can really talk to those things a lot better than I can. And I know that the Q3 report just came out. We still have that 22% vacancy with a slight uptick in net absorption. We're seeing that, like you said, across kind of quarter over quarter of those things kind of holding steady or going back and forth. But the biggest thing that we are seeing when we're talking to brokers and potential tenants is most of our deals right now in the office space are coming directly from the real estate owner themselves, the owner of the building, not directly from the tenant themselves. And so that means we're going in, we're doing a lot of lobbies, corridors, amenity spaces. We're doing a ton of spec suites in exactly that square footage that Carl was talking about, which is less than probably 10,000 square feet. I think we can talk about that and we will talk about that in more detail, but that's certainly over the past couple of years what we've seen. Probably upwards of 70% of our deals in the office space have been that.
Yeah, I'll just echo what all the gentlemen have said. I mean, it's a soft market. I think kind of a surprising trend. It's not really super surprising, at least from my perspective, given, I spent my first 12 years in Houston, Austin is moving into a slightly more mature office market. The construction boom over the past 10 years has added a ton of inventory, and you're finally reaching a point where there are functionally obsolete buildings. And I heard it, I can't remember, might have been at a ULI event, but one of the main developers said Austin finally has, I think he called it structural vacancy that essentially will more or less always exist. I think your older Class B buildings, even older Class A's, that will always kind of decompress rates, provide an economic advantage to tenants. So it's something worth noting that as Austin moves into a more mature office market, you're going to be dealing with more overall vacancy than Austin's probably used to dealing with.
Alex, you said something on our panel call that Franklin Street was wanting to put an office in the Sun Belt in Texas, and you selected Austin
Correct.
over the other Texas cities.
Yes.
I think everybody here would like to know why you made that move.
Well, that was not my decision, just FYI. I was recruited after that decision was made. But, naturally at the time, I think it was 22, when they probably decided Franklin Street's based out of Florida. So Sunbelt, high growth, they look at Texas, Austin was the shooting star in the market for years and years. Obviously, it's starting to parachute back down a little bit, but Austin, obviously, rate growth. You look at the growth of rental rates in Austin up until 23 may have led the nation for all I know. It certainly would have been in the top 5. So that certainly would have added to the decision as to why Austin was the market they wanted to enter in.
And that leads us into our next topic, which is rental rates and demand. So we have been very fortunate to have, we've been riding the skyrocket. We've been skyrocketing rental rates across all property types here in Austin. And now that we have more vacancy than we've had in quite a while, are rental rates dropping like tenants would hope? I can imagine I get tenant calls and they're like, well, I'm looking for a deal, there's gotta be a deal. Are there deals? Rental rates going up, down, stagnant?
I think this is a really interesting question. I think sometimes the news and the outlets that we read from paint a picture that Austin has a really steadily increasing or holding rental rate because it's such a strong market, it's boutique, there's lots of demand, it's the #1 city to live in. I'll put it like this, indirectly answering the question. I think one of the most interesting factors that's going to play into rental rates is our sublease availability right now. So this question also rolls into the first one, which is trends, but you've got and you have a building stockpile of sublease space. I think the number right now is at 6 million square feet. It was at 5 million at the beginning of the year, but growing quick. And on a 5-year lease cycle, you've got a lot of this space coming back to the market. I mean, so if you've got a 23% overall vacancy rate, that number is not accounting for the 6 million square feet of sublease. And if you've got a 5-year lease cycle, you've got a natural amount coming back to the market. So add in overall decreased footprint from users, then add in sublease space going back to market, I think you've got an inevitable decrease in rental rate. I'm cutting deals at the cheapest rates we've ever cut them, but they're still high. Like, I'm still doing deals at $50 per square foot downtown, $40, $45 on the east side, which is expensive. But yeah, I think overall it's inevitably and economically going to decrease.
Yeah, you look at the numbers and you see rates have kind of plateaued over the last little bit. Landlords obviously are trying to maintain the highest value of their building, keeping rates as high as possible, throwing in additional dollars for TIs, free rent, other concessions just to maintain the value of the building. When you look at past cycles, rental rates have a tendency to fall like a feather. So in these markets, it takes a while for landlords. They'll do anything and everything they can to maintain that rate. And then when the market turns and they can get bullish quickly, and they'll have a tendency to rise like a rocket. So we're in that feather stage, but a lot depends on where you're looking in the market and what you're looking for. I think coming back to the Class B buildings and those, I don't want to say functionally obsolete, but more obsolete, not as well located, you're seeing a lot more price, concessions there than if you're in, looking downtown for Class A space and the most desirable properties there. But even then, you're seeing that there's price pressure that's coming, and we're starting to see that downtown. So I think we'll continue to see that, but I know we'll talk about this more. I'm optimistic on the future of Austin.
When you talk about vacancy, what about absorption? I mean, I know it's all statistically driven, but.
Yeah, I mean, you look at absorption, and it's been, we had 750,000 square feet of positive absorption last quarter, but you've also got a lot of new construction still to deliver through 2026, so that's gonna have an impact on there. And then you look at past quarters, and it's been negative, and then positive, negative. And so I'll throw this out, Brian, for you. Looking downtown, if you look at new construction that was delivered 21 through 2026, that's roughly 60% of that new construction has been leased or is pre-leased. That leaves about 2.7 million square feet of vacant space again, new construction. On the surface, that is a lot, and there's opportunity to do a deal downtown in that range, but I see that as a window because tech has been down. Right? So if you think about tech, Google, Facebook, or Meta, Indeed, they each downtown have about 1 million square feet plus. So that 2.7 million square feet of vacancy in the newly constructed product could be gone very quickly, and there's not going to be any new construction coming online beyond 2026 in the near term. So you could see, if there is a turnaround in the market and it comes from tech and those tech players move big and bold, that window that there is out there today could close, fairly quickly. And that's what we've seen in the past in Austin, is just we've been last in to these downturns and first out. Who knows what will happen, but I think that if we are first out and it is big, it could change quickly.
I'm just curious what you guys think. Is this 3 to 5 year turnaround? I don't.
Hard to know.
I don't know. I've been around a long time. I've just seen a lot of ups and downs, but I've never seen it like this.
Yeah, no, I agree.
I'll say it. I think I've been earmarking the health of the market as like on the long end, I've gone 5, but I'm earmarking it as like a 3.5 year hiatus stretch until we see something significant happen. And I'm thinking that significance is going to be positive absorption, return to office, but I'm thinking that the hunker down period's going to stay for a couple more years.
I think there was a report that came out early October that Austin's work from home was the #1 place in the country for work at home, at like 28%, when the national average was 13%. And so we know that there's been a lot of rumblings about big tech companies getting back to work. That may be an initial kind of trend where we see that start to break. when that happens, I don't know. Some of the larger tech companies that are work from home, yeah, we've seen a lot of trends, at least on the design and construction side, attempting to bring people back to work.
I mean, to that point, this is purely anecdotally, but over the past, and I think I mentioned this on our call last week, but anecdotally, we've probably heard from more small to mid-sized tech firms in the past 2 months, give or take, whose execs are expressing the interest or desire to get their employees back to the office. So, our job is to kind of help push them along in that direction. Obviously, naturally inclined to want to do that, but that's reassuring at minimum. Whether or not it happens, they've told us it's a struggle, but it feels like it's beginning to thaw a little bit, and that they are realizing, okay, if we're going to scale this company, how are we going to do it purely remote? I'm sure there are some industries and companies that can do it, but building culture is definitely hard to do remotely. So that's been reassuring at minimum, that we're starting to hear from the companies who are really leading the charge and saying, we're working from home, that's happening indefinitely, to now you're starting to hear a little bit of a trickle of, okay, we would like to figure out a strategy to get our employees to come back to the office. How can we do that? And it starts with the office space.
I'll just add to that. I think it was yesterday or the day before, CoStar listed a bunch of deals that transacted recently in the market, and I think there were 5 or 6, and they were all 18,000 square feet and above. PayPal was the biggest at 90, but we had not seen that 20 to 30,000 to 50,000 square foot deal. They've been on the sidelines, and so to see 4 of those deals happen over the last quarter, I think is a really positive sign. And interesting, the whole flight to quality. 4 out of 5 or 5 out of 6, whatever it was, all went into newer buildings, higher quality, better located buildings. So they're not, while they're looking maybe for a deal, they're not necessarily looking for, they're investing in real estate because they need to bring those people back into the office for that culture to drive that innovation and things. So I think that's all positive.
We worry about stability of landlords with loans in.
Oh my God. Logan's gonna take this one.
We try to subtly dodge this question because it's difficult for us. I'm going to speak for the panel because we've talked about this. It's difficult for us to address the economic health from a commercial backed mortgage security or a debt perspective. There's people that can just speak worlds to this. That's not me. I don't think anybody up here is one of them. John back here was asking about this too. I think it's a really relevant topic. I brought it up on our panel, and that one interesting element to this whole scenario is as the pressure increases, by way of vacancy in these buildings, loans are maturing, so your commercial-backed mortgage securities are ballooning, they're coming to date, therefore you're seeing the keys being forced or foreclosed back to banks. And what are banks going to do with buildings that don't have demand? Who knows? And what does that do to our economic health? Probably not good things, right?
They probably don't want them back.
Exactly. So we're starting to see that happen, right? Like, people have been trying to push this off, but I can give a couple examples where this has happened. And I think the first place it's going to happen is, well, frankly, where debt's maturing, but I've seen it happen in one instance on the east side. The future is going to be unknown, but I don't think it's going to be there's no scenario where it's going to be positive from an economic health perspective, but I do think it'll be positive from a tenant's perspective, and I think it'll really create that sliver of opportunity to motivate people to go into some really nice buildings.
I guess you're trying to protect your tenant when they sign a lease, just in case if the building does go.
Yeah, you do. We talked about this on the call as well. Like, obviously, coming from Houston, operating there, you go do oil booms and busts. Buildings go back to lenders all the time, so you get pretty adept at kind of dealing with how do you approach that with representing the tenant. We've done things as we've asked the landlord to put TIs and commissions in escrow. You obviously always ask for things like self-help rights, offset rights, so that you can go in there, and if they cannot make payments or there's something going on, but it goes to foreclosure, they can offset rents for TIs, at interest. So you can get creative in ways of kind of protecting your tenancy. Obviously, an SNDA now should be standard for any building with the lender. But those are the things I think as a tenant advocate that we would focus on traditionally.
which I think is excellent. So whenever they brought this up, I put it in my notes that, just so you know, as a landlord, I am willing to put your commission and TI allowance in escrow for you to show how strong we are.
You're
And I
gonna be
think,
around a long time.
What?
You're gonna be around a long time.
well, because of that?
No.
Okay, yes, I mean, well, and I think the key that I wanted everybody in the audience to know is if you're repping tenants, you should probably be having those conversations and putting them in your LOI. Why not? And then I think like the flight to quality, that will be considered a quality landlord. Tenants will want a quality landlord so they know they're in a stable building. And I know this about amenities. Amenities work great in a building whenever you've got 80% or plus occupancy. If you've got low occupancy, those amenities start to dwindle. You've got unhappy tenants. So the strong tenants are going to want to go to buildings that are beautiful, have all the amenities, do the deal right with all the negotiating, and have a very strong landlord that's willing to be a partner and get things done.
What specific information would you ask for a landlord?
That's an interesting question. So many buildings are owned on one-off LLCs that you can ask for. Let's see your capital stack. The capital stack doesn't really have anything in there, and there's no real teeth that you could apply. We literally just went through this. I did with one of the deals we were talking about at CoStar. So we try to dive into it as much as possible. Obviously, getting an idea of who the equity partners are can be helpful. Probably not going to get financial from equity partners unless it's just a very large deal for that building. So there's a little bit of like, just make us feel good about it, understanding the partners, kind of on a personal level. I'm not an expert.
When the debt matures.
Yeah, correct. Obviously, you can take a look at what the debt matures. So yeah, those are some of the things you can try to do your best. But yeah, we literally went through this. Our attorney said, well, hey, we can ask for whatever financials we want from this LLC. There's nothing in there. It's just a shell LLC for this one asset.
Yeah, because I mean, isn't it mostly institutional owned or publicly traded? I mean, they're not going to give you financials.
They won't give you financials, but why couldn't they put it in escrow? Why couldn't they do something that
Well, they should.
puts the money there, then the landlord's not spending it, therefore the tenant feels good that they're gonna get it. And these brokers, I don't know who's a broker in here, they wanna get paid. No brokers wanna find out that the landlord's not gonna pay because they don't have the money.
So obviously, flight to better product. What's going to happen with the older product as it gets older? Redevelopment.
Well, this is the one I am super excited about. As a landlord, I can build the most beautiful shell of a building. But what I have figured out in probably the last 18 months is what's inside matters. The tenant finish out, the amenities, all of that. And these gentlemen are touring properties, talking to tenants day in and day out. So we're gonna let every single one of them speak, starting with construction, because he's the boots on the ground, he sees the deal get inked and then proceeds forward with construction. So what are you seeing?
Yeah, I think all of us, we touched on this a little bit already, just some of the trends that we're seeing. I think just from a construction dollar standpoint, the market really got shocked, in 21, 22, we saw construction costs increase about 14%. 23 was about 5%. This year it's actually looking like it may come down. Now coming down is like 1%. A lot of that's due to a softening in some material costs. Well, we still have continuing to see an increase in labor costs. And so, back in, pre-COVID days, there needs to be, or there still is the market kind of catching up to this, where it felt like, pre-COVID days we would get, to proposing GMP, the budget to the client, and we might have been somewhere 3, 5, maybe 8% over budget. And that was pretty typical when the client, we're looking to get all in there. And then we're going through a process, and we were value engineering, we were able to cut that 3 to 5%, and we're able to move on. Kind of post-COVID, with the adjustment period that's still taking place, it felt like very frequently we were 8, 12, 15% over budget. That's a tough pill to swallow, and it's a very difficult value engineering process. And a lot of times that may kill a deal, right? But the company may not have the ability to be able to pay that additional portion. And so what are they looking at, right? And so I think that's one piece where we've seen the real estate owners make a transition into how they're presenting their spaces. We already talked about the typical square footage of a space. We're seeing 5, 10,000 square feet max on a lot of these. where the tenant it may be their first office, it may be their second office. You know, it's a tech company, it's a small growing company. We're talking about those larger square footages needing to go through the entire permitting process. The entire construction process is very laborsome. They don't have the time, they don't have the effort when they're running a business to be able to go through that process. So what we're seeing is a lot of tenant-ready spaces. And the owners that are willing to go put the money in, and obviously lobbies, corridors, and tenant-ready spec suites are the ones that are able to sign up these tenants. And not to take too much of the time, but you know, pre-COVID, what did a tenant-ready space look like? That was a white box space. That was building standard doors, frames, hardware, ceiling tiles, rubber base. Now we're seeing the real estate companies spending $135, $155 a square foot on a tenant-ready space that a company can come in, they can see their company existing in this space. There's a lot going into the space planning. All they're gonna need to do is, hey, let's add a phone room, let's move a conference room, let's add some branding and a reception desk that has some of our branding, and let's move in and go. So, sorry to take too much of that time.
I think one way landlords are combating the high costs is they're trying to get some economies of scale. So they may take, for example, just instead of this one 3,000 square foot space, this one 5,000 square foot space, they may have lost a large tenant that took up a whole floor. They're gutting the whole floor at 25,000 square feet and breaking it up into 3, 5, 7, 9,000 square foot blocks in order to get that construction economies of scale to make the numbers palatable and more attractive across the board.
Tell me about amenities. I mean, what are amenities these days? Do I need a coffee shop on the first floor? Do I need a gym? Do I need a cold plunge? What are the things that tenants are willing to pay for?
I think we can all speak. We've done some deals and buildings together on this panel this year. I think the one trend that we're all seeing is, someone mentioned it, but it's our 10,000 square foot deals or 15,000 square foot deals we were fortunate to do 5 years ago have come mature, and most of those tenants, I can speak to half of my book of business, has gone from 15,000 to 8,000, and the difference that's being made is into really high quality buildings, right? So we might have come from the corner of the east side into one of the beautiful new Hines developed buildings closer in the more central district where it's walkable and the amenities are great. So great amenities are I think walkability tops the list in terms of for Austin amenities. And then you just don't see in our market comparative to like Dallas or Houston these amenity-rich buildings. There are a few, and they're becoming more common, and that's like the one gap in our market we don't have in comparison. But I don't find tenants craving crazy amenities, but they are becoming more relevant. Probably the pressure is on to build cool amenities.
They say they want amenities, but the amenity they want the most is location.
What is location?
They will
Tell
give up a big gym and a big conference center for the ideal location, easy to get to for their employees, walkable to a lot of local amenities. They want to be able to get to the coffee shop. They want to get to Whole Foods. That seems to win out when we lay it all down and compare.
I think one thing I see with tenants that are downsizing that still have more employees than they would actually have to ask for is an all-hands space, something that's in the common area. So as they downsize, the only time they ever really need to have everybody in.
And I repeat what he said about the all-hands space.
Like town hall space.
Town hall space. And do you mean that it's an amenity that's available to the entire building, or the tenants want it built into their private office space? So like a conference room with a table and a screen, or are we talking something way cooler?
It needs to fit everybody.
Needs to fit everybody.
And I think the trend you're alluding to is just how do you accommodate 100 people in a 5,000 square foot space? Yeah, and I ran into to be very specific, one of the interesting problems I ran into doing deals this year on this trend is like parking. So how do you accommodate 100 employees in a space that only fits 25? And the answer is, well, we're only gonna bring the equivalent of 5,000 square foot of people or 25 people in at a time. We're not gonna have 100 people in here, but it's these little changes that are really affecting how space is built out, and it's putting the pressure on, like the specific example of parking systems, of how do you give somebody a 3 per 1,000 ratio, but then make sure 100 employees have parking passes, right? And the same goes for how these spaces are laid out, right? So how do you accommodate 100 employees in a space that alternates 25? And the answer to that is simple things like don't build private offices. And you're seeing that reflected in how tenants are delivering spec or cold or shell, however you want to call it, space. But that's a great question. That people are just using this space in wildly different ways. And it's bringing issues and challenges and lease changes that are new to me, and I think all of us.
But then let's say they've got an annual meeting or conference or workshop, they're not gonna be able to have it in 5,000 square feet. They're gonna have to go someplace, a hotel or someplace to.
Yeah, I think that's your point, and I'll speak to a deal I'm finishing right now, which is the requirement was to be able to accommodate it 6,000 square feet, but the ability to accommodate 50 people in a conference room, right? So we're definitely not accommodating 50 people in our conference room. So that actually eliminated a lot of, and some of the newer builds that had, you know, I like 415 Colorado is the building I'm thinking of. It's beautiful. It's got one of the best views in town. It's boutique, class A++, but they did not build a conference room that could accommodate more than 25 people. And so that took that building off the list. So again, like the landscape is just shifting and changing. That's the trend I'm seeing.
Have you seen the trend, the trophy building trend, like what you guys are talking about, nicer buildings and like good amenities and cool amenities? And because the employees are not coming to office, right? Employers are renting.
Yeah, so
Repeat it a little bit.
so the question is, what's happening with trophy product, you know, which is being used to attract the talent in, and if you're not a trophy building, what do you do, and those type of things. And so when you look back at the last 4 years, we looked at, there were like 24 law firms that were 10,000 square feet and above that did deals downtown. It was pretty interesting when you kind of peeled some of the data back. 55% of those deals were done in buildings that were built 2020 and earlier, or later, if you will. So in other words, they're going to high quality, newest and best, most amenitized, all of those things. Well, then when you add in buildings from 2000 to 2010, so the prior development cycle, now you're at 75% of those deals were done in those those newer, higher, better buildings. So that leaves 25% in what downtown is, which is kind of the mid-80s vintage. Well, what's happening in those buildings? They're spending millions upon millions of dollars trying to keep up with the newer buildings. If they don't, they're not going to see 25% of deals, they're going to see a lot less. So it's an arms race on the amenity side as well. So it's pretty interesting. So, you know, to walkability, not everybody's going to can pick up and move their building. So you have to bring in different types of environments into some of those buildings, whether it's an all hands space, kind of a cafe type space, maybe even like using Breaker Point here. It's across the railroad tracks from the Domain, and it's $10 a foot less than Domain proper because it's not walkable. But it's right there. So what do? You bring in some amenities into that project, a cafe, a place for the employees to do work in a more casual setting. And it's what you can do. Or you bus them to the Domain and pick them up after lunch. Like you have to get creative, right? I mean, it's not like they can pick up their building and move it.
So you mentioned Breaker Point. Just curious what the demand or lack of demand for being in the suburbs, so to speak, not downtown, not the Domain, not the east side. Because the triple nets in the parking downtown are just horrendous.
Right.
So are you seeing a little bit of flight from downtown just to avoid the traffic and the hassle?
There's some of that. The challenge is there's a gap, right? Central Austin is like 1.5 million square feet of inventory, and downtown's 17 million square feet. So if the supply was there, they would do it. But you've got to jump from downtown to north of 2222. Well, that's a big, shift. So then you kind of start looking at the domain. It's 8 miles from downtown. It's not very far, but again, you can be just outside the domain and you're paying $10 a foot less, and then if you go further out, you're paying $15 a foot less. It's just the reality.
I'm just curious how, y'all's opinion of how you feel like the suburbs are doing right now. I mean, I know you go up and down 360, it's a ghost town.
And that's a tough one. 360 is tough, right? I mean, it's a tough spot, but it's close to where a lot of executives live. So I think what you're seeing on 360 is there's still some demand, but it's much smaller users, right? It's 5,000 square foot tenants, 10,000 square foot tenants. The bigger folks are going into the domain or much bigger projects where they can attract. It's easier to attract more talent. Yeah.
That makes sense.
So, because I thought of this earlier, the rule of thumb used to be that the execs or the owner of the company would always end up putting their offices within 5 miles of their home. And it sounds like, but I am curious if it's true, it sounds like that has actually changed to where now it's where the employees are. They got to put the offices there, and then the owners and executives have to drive.
Yeah, it's different, and I compare everything to Houston. That was it. In Houston, oil and gas heavy, obviously, professional services heavy. You would do all of these demographic studies, commute time analysis, and then you put a star on the CEO's house, 1 mile radius, and that's probably where the office was going. Midway, a developer out of Houston, built a place at City Center, mixed use, tons of office, hotel, right in the Memorial Villages area. If you could build something similar to that in the Westlake area, it would probably do gangbusters, I think. You need the square jumps, you need the acreage to be able to afford putting like a good domain light somewhere over there. It would probably convince a lot of CEOs to be like, yeah, we're gonna be over here. You have all the amenities, everything's here. Whether or not that could ever happen, no idea, but just my thought.
And I have another question, because I'm sitting here as a landlord going, great, I'm gonna build an all-hands area, and I'm gonna put in all these amenities. But what I know is that is going to skyrocket my triple nets, my load factor, and all of that. Are tenants readily gonna go, I don't care, I gotta have it? I mean, or is there a fine line where the tenant says, I'm not paying $40 a square foot triple net?
I, for the first time in my career, saw a tenant pass on a building because of load factor. The load factor was 30% in this case, and it was downtown. Load factor is typically 17 to 25, like dense amenity-rich buildings. So that was really interesting to me to see someone tip a deal because of load factor. So if you're gonna jack your load factor up to 30, you better have some really freaky cool amenities. Like they better put a bowling alley in there. You better be crazy, because at that point you're servicing and selling to a client and a tenant and an occupier who probably is not very price conscious. Yeah, I think that tips the scale. Like on your notion of trophy buildings, I definitely think there's a line that gets tipped where you're not going to attract much better of a tenant by increasing the amenities to a 30% load factor, but they are important.
Well, I mean, they've answered so many of my questions, so I've gotten a lot out of this. We are going to go down the line and have everybody give their predictions for either the year 2025, 26, 27. You get to pick. What do you think is going to happen in the office market in Austin?
All right, I'll say deals are going to continue to get smaller. They're going to become more frequent. Prices are going to drop, but not significantly, maybe a 5% price reduction in anticipation of a more dramatic price reduction in the following year and years. Suburb deals are going to get cheaper. You're going to see more of them happen, and vacancy will stay the same. That's a lot.
Did you miss anything?
No, that's like my neutral take. I can write it both ways, but that's my neutral
All right,
take.
well, I don't have all that, but I'm cautiously optimistic. I think you have to be. I think Austin and Texas continue to be where companies want to be. I think you're going to see there's going to be pent-up demand that we'll start to see come into the market, I think, next year with this election being over, and just I think companies having, I think the Amazon comment of, hey, this may not be the right place for you if you're not interested in coming to work. and I think you're gonna see more companies take that approach. I think companies have to, in order to be innovative and to drive business forward and grow, whether it's professional service firms, which are heavy on the apprentice program, or tech, I think you have to be competitive in today's world. You have to have people coming in and collaborating, and we're even our law firm clients that need different type of space. They're looking, or not different, but I'd say what they're looking for is more collaborative space where people are coming into the office and either meeting with clients or working together in teams. So I think that trend will continue. It may be slow, may not just bounce back. I think it'll be a little bit, choppy. It won't necessarily be a broad brush, but I'm optimistic that we'll see positive things as we move into the next couple of years.
I'm very optimistic as well. Excuse me. I think it's two-part. I do agree that we're going to continue to see more frequent smaller deals of the 5 to 10 to 15,000 square feet. We'll continue to see, I think, construction costs level off. So as the market kind of better adjusts and better plans for where that construction dollar is now, that will make deals go smoother. And then I think this combination between, and this, I'm kind of outside of my realm here, but when we're talking about Austin being the highest work from home at 28%, we also know that there's about close to 3 million square feet of corporate office coming online over the next couple of years. It feels like there's a lot of sitting on the sidelines right now for the really large tech companies in Austin. And so there's going to be a fight for the talent as it goes back to work. And I think that's where we're going to see the Googles of the world, the TikToks of the world, the Facebooks, those companies lease up those spaces, acquire the better talent as they go back to work. If you're going back to work and going back to the office, what office do you want to be in? Do you want to work for Meta? Do you want to work for Google? I think a lot of that really high talent pool is going to go work for those as they absorb the upcoming close to 3 million square feet.
One quick question about construction. You said you think they'll level off. You don't see them coming down, do you?
Well, 2024 trend actually does, we do see a downtick, only about 1% of construction construction costs, which is just kind of mind-blowing after you look after, like I said, the 2021 and 22 trends of 14%, right? The market is still kind of shell-shocked by that and adjusting to that as we see a lot of tenants and brokers going in and having conversations very early on about what those construction costs are going to be. So that's really positive because I think that the brokers and tenants and those people who are early in on those deals are starting to adjust to what those costs look like and able to better plan for what those deals look like. Do I see, not only, everybody talks about, the Samsung, the Teslas, the bigs that were able to grab a lot of the talent in construction. That drove up a lot of the labor costs on, what we're seeing in kind of central business district for, your typical corporate TI, right? We still have a lot of those large buildings going up, waterline projects, those types of things that are taking a lot of the top talent. I could see the labor costs coming down, 26 maybe, maybe the later part of 25 as a lot of those buildings start to come online, just as we're going to see, there's not a lot of new development. There's going to be a break in kind of that new development in a lot of projects that didn't start kind of pre-COVID, where I could see some softening. We've seen softening in material costs of about 3% this year. I could see that labor cost come down as well, maybe later part of 25 or 26. Not an economist. I'm just trying to follow trends.
No, but is it
and the data
when you're
base.
trying to factor in what your construction costs are for your TIs and all that, it's important to know.
Yeah, I would say, I would advise, get a good beat and a good understanding of what construction costs are right now and work on making that adjustment and planning right now and not anticipate, that we're going to see 8-9% increases over the next coming years. Hopefully we start to see a little bit of level over the next couple years.
Not much to add past all that. So 2025, the year of the bespoke spec suite continues.
I like that. So my view of everything is always further than 2 to 3 years out. I always take a view of look at where the government money is going. We have enormous projects in Austin, I-35, TxDOT, we have the Convention Center, we have Highway 71, we have the airport, on and on. The government generally doesn't spend money unless they've been studying it for decades, and they are spending a lot of money here. My very good friend and partner at Workbench, Mark Vornberg, told me, I think it was about a year ago, that Austin, Texas is like Los Angeles in the 70s. So Central Texas is going to explode. Is it going to explode in 3 years? I'm not saying that. What I'm saying is we might be in a slower market right now, but just hang in there because it's going to be all right. I mean, we are sitting in one of the best cities, clearly in the best state in the United States. It's all going to be good. I do believe for office, the landlords that are creative and involved and willing to get their hands in with their tenants to get a deal done are going to come out the winners. And that's what I've got Mark Warnberg sitting back there. They're going to test fit. They're going to do everything that we can for you for our office space on the 4th floor in East Austin. So call me if you need 6,000 square feet. Bring me a tenant.
Yeah.
Bring me a tenant. I'm ready to do a deal with you. Do we have time for questions or?
We do, if there's any more questions. We have some great ones from the audience, so thank you so much. I mentioned that on the call, how we, because of for that, but any other questions before we let the fan on? Go.
We just did a deal, Alex and I just did a deal in T3 on the east side, and I thought it was one of the coolest buildings
That had been done. Hines led the development. They did this biophilic, very eco-forward building where it was all mass timber construction. So it just had a very unique and different feel. It wasn't big. I think the total
It's like 90, less than 98,000.
So 3 floors, small floor plates. It was next to one of the best new coffee shops in the East Side, Cosmic, so it hit that walkability. I'm a huge East Side advocate, I know. And you are too, but yeah, cool boutique buildings like that, walkable spaces are gonna come ahead.
As companies start to go back to office, are you seeing any specific trends on how they're doing their programming that's very different than what they did before? And I think one of the issues that I have with some of my groups is they're having a hard time really figuring out what they need until they get back in.
Yeah, I think, we do hospitality as well, and it feels like there's a little bit of a blend in hospitality in the corporate office in some of the areas that we're looking at. I do think, there's been enough as people are going back, and what seems like a trend is people are in the office 2, 3, maybe 4 days a week. A lot of that is for collaboration time, and so, really honing in on what breakout space looks like. And so the break room may have more kind of soft seating and collaboration space, conference rooms or huddle rooms. They're finding that it's either for 4 or it's for 8. That 6th person is not generally, it isn't filling the gap between, it's either maybe 1 or 2 or 4, or the 8 person or larger kind of breakout space and huddle space. So that's, some of the trends that we're seeing.
Yeah, same thing. It's collaboration heavy, but it's really dependent upon how it pays to make sure your client knows how their team operates. And sometimes that takes surveys, kind of in-depth studies, but collaboration is kind of the name of the game. They figure they can get some of their head down work at home these days, a couple days a week. So incentivize them to collaborate within the office. That's what we're kind of seeing.
Anyone else?
You were saying that vacancy rate is pretty high and it's going to stay the same, that you were saying that. So do you think, and the demand for office is not as robust, like you were saying. So do you think you'll see some of the office building go into the conversion?
I don't think so. I think conversion's really difficult, and I think it's difficult from a permitting perspective, but that's a really great question for people in construction. I'm just a broker.
It's very expensive. It is extremely expensive, and it takes the right office building that you can even do it. I think 5% of the stock in the United States could actually be converted.
And that's not in Austin.
And it's- yeah, it's not
You're
in
gonna see
Austin.
that in like New York or larger, more mature markets. Austin's a
San Francisco
relatively
seems a lot.
yeah.
It's clickbait. It's clickbait. People
There's-
click it. Oh, we should do that, but it's very difficult.
Yeah, I think there's going to be a period of time where we're going to have enough case studies to figure out how to make the design and construction work. in those, in the conversion from office to residential. Right now, there's a specific building type that works for that. Again, a lot of that product isn't in Austin. A building that was built from 1930 to 1960 seems to be kind of some of the older type product that works best for the conversion, where you're getting like studio space, but they may have had, breakout of different offices and kind of that central corridor space, and the MEP systems that are going to allow for it. So there's a specific, we'll have to get a ton of case studies in that specific product type to really figure out how to make those conversions. But it's incredibly difficult, it's incredibly challenging. It's kind of clickbait right now.
I think one thing you will see in Austin, I think this is in lieu of that approach, I think the domain Burnett Gateway area, so not necessarily domain proper, but the outline of that area is where you're gonna see conversions. And that'll be converting industrial buildings into mixed use, multi-tenant, residential office. I mean, you can do you can take a obsolete industrial building and create a 5-story to 30-story building on all that land, and that land is 2,300 acres. To put it in perspective, whereas downtown's 1,000. So that to me is where you'll see more affordability happen, is in that area. It's population center of Austin too, so I think you're gonna see a lot of growth in this area.
Awesome. Well, let's give our first panel a round of applause. And let's take a 5-minute break. So if you need to go use the restroom straight out this door, coffee is in the front, and I believe the food is still set out.